Today we'll talk about internal control in accounting. The first question is, why do companies need internal controls? Errors made by humans can cause errors in the financial statements, for example, accidentally taking inventory with the wrong number and so on. Therefore, internal control is needed. What is internal control as well? Internal control are policies and procedures established by management. It needs for ensuring that the company's financial statements are reliable in accordance with generally accepted accounting principles, and to ensure that the company's assets are protected. If a merchandising company does not take steps to protect its assets, it can suffer high losses of cash and inventory. Let's look at one of the assets and inventory. Remember that ending inventory includes goods still available for sale and held by a company at the end of an accounting period, like goods that are ready for sales. They can be located on shelves, in storerooms, in warehouses, or in trucks between warehouses and stores, also between supplier and merchandiser company. For example, if merchandiser company gets title to the inventory from the suppliers. Ending inventory does not include goods that sold but not yet delivered to customers, also damaged goods, except if this damaged good can be sold at a lower price. And now, assume someone stole an inventory of 1500 tenge. So, merchandise company has lost 1500 tenge. How they can identify it? Let's say merchandise company stops selling its items temporarily in order to check inventory on the last day of their fiscal year. Then merchandisers usually take a physical inventory. As you can see, physical inventory, its process involves count of all inventories on hand. The missing 1500 tenge, like our inventory, are not in stock, so they cannot be counted as good available for sale. Then 1500 tenge implied as sold good. The cost of goods sold then is overstated by 1500 tenge. There is a difference between the actual inventory and the amount in the records. The ending inventory then is updated. 1500 tenge would be in the credit side of merchandise inventory account. Account is reduced by this stolen amount. In this way, management's responsibility is to establish an environment, accounting systems, and internal control procedures that will protect the company's assets.
So companies should take steps to protect its assets, otherwise it will suffer high losses of cash and inventory. To avoid this kind of events, management of the company should set some system of control. An effective system of internal control consists of 5 components. First is control environment, which is created by the tone that management has set in an organization. It is about company's procedures, philosophy, and personnel policies. Personnel should be qualified to handle responsibilities, which means that they must be trained and informed about what is expected of them. For example, the manager of a retail store should train employees to follow prescribed procedures such as handling cash sales and so on. Second is risk assessment. It is about identifying areas in which critical risks lie and designing controls to address those risks. An example of a risk in a retail store can be customers stealing goods. A manager needs to address these risks by setting cameras at stores. Third is information and communication. It is about how does management communicate to their internal and external users what is expected of them. Fourth is internal activities. It talks about policies and procedures put by management to control the organization and if these tools of control are operating effectively. And the last one is monitoring, which is a regular assessment of the quality of internal control. Large companies often have a staff of internal auditors who review the company's system of internal control to determine if it's working properly. So control activity, which is the fourth component, is a very important way of implementing internal control. Its main goal is to safeguard a company's assets. It includes first authorization, meaning approval of certain transactions. In a retail store, for example, cashiers usually authorize cash sales, but other transactions such as issuing a refund may require a manager's approval. Second, recording transactions. This is needed to establish accountability for assets. Third, documents and records. Documents are needed to ensure that transactions are properly recorded. Fourth, Physical controls. Physical control is a control that limits access to assets. For example, in a retail store, only the person responsible for the cash register should have access to it. Other employees should not be able to open the cash drawer when the cashier is not present. Fifth is periodic independent verification. It means that someone should periodically check the records against the assets. For example, at the end of each day in a retail store, the manager should count the cash in the cash drawer and compare the amount with the amount recorded. Six is separation of duties, means that each employee oversees only a single part of a transaction. And the last one, sound personnel practices. Personnel practices that promote internal control include adequate supervision, insistence that employees take vacation, and bonding of personnel. Bonding is checking an employee's background. However, bonding does not 100% guarantee no theft, but it does prevent or reduce loss if theft occurs. This kind of personnel practices help ensure that employees are honest and will find it difficult to carry out the embezzlement. Thank you for your attention.